Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This item is brought to you by my company, Bull Realty. If you'd like to sell an office building or any commercial properties, land, or multifamily, reach out to me. My email is michael@bullrealty.com. Well, today we're going to talk about what I think is the most interesting sector in commercial real estate these days, and that's the office sector. Seems to be the most in question, right? Everybody says office is dead. We can all work from home. What we love the no commute, right? We can pet our dogs and be close to our refrigerators. This is just wonderful, right? But we're starting to see some companies, or a lot of companies, and employees get back into the office buildings, but there's still a lot of question about the future of office. Let's explore it. Please welcome my guest. It's Tom LaSalvia. He's senior economist with Moody's Analytics. Some of you may remember the company Reese. Well, it's Moody's Analytics CRE. Tom, good to see you, sir.
Michael, always a pleasure. Thanks for having me.
Well, thank you. And as I mentioned in the open, there are a lot of people out there kind of question, do we really need office anymore? I mean, do we really need offices?
It's a great question, and I don't think we have the exact answer yet. There has been some studies in industry. There's been some studies in academia about productivity, but I think this is going to play out over the next 5 to 7 years, and we're going to be able to see, hey, has innovation dropped, right? Are people able to learn on the job in the same way if they're mostly remote? Mentoring, how does that happen, right? So I think there are questions, and I think a lot of companies are being guinea pigs, the ones that are trying either way, to be honest with you, because the ones that are taking a hard line, is this going to mean more difficulty getting the skilled labor they need? And the others that are going more remote, are they going to suffer from those same things I was just mentioning before?
Yeah, I mean, are we going to be able to buy Tesla after this?
I'm not sure what's happening there. Obviously, Elon Musk has taken a hard line there for now, but who knows what's going to happen?
Yeah. Yeah. For those of you, if you haven't heard, I'm sure our audience has, he kind of said, tell everybody to get back to work at least 40 hours a week and do it in the office where you're supposed to be working, right? Or the factory. So yeah, it'd be interesting to see what happens there. Well, Tom, how is the office market performing overall when you look at the U.S. office sector?
Yeah, we had expected to see quite a bit more stress given what's happening, given the uncertainties. But really, this has been a benign downturn, at least in relation to, say, the Great Financial Crisis or even the recession from the early 2000s. In those situations, the office market really had a tough time. We saw vacancy rates spike. We saw effective rents fall quite a bit, and it took a while for them to come back. But this wasn't a financial crisis. A lot of the office using firms, they had record profits, record stock prices, not so much anymore, but record stock prices during the pandemic. And they were able, even if they weren't going to the office, they were able to fairly easily pay their rents. There was no need to break a lease, that's for sure. And, this has led to, at the worst of it, we saw about 1.5% decline in effective rents, but we're already on the upswing a little bit. The second half of 2021, things kind of stabilized from a rent perspective. And from the vacancy perspective, we peaked out at 18.5% at the national level. We're down to around 18.2, 18.3% right now. So there has been a little bit tightening, but still 18% is nothing to write home about.
Yeah, that's true. So what do you suggest we might see moving forward, Tom? Is, there's a lot of companies, right, that are leasing space that aren't using it all, right?
Yeah, we're still seeing physical occupancy hover below 50%. We often cite the castle swipes there, and there are certain cities, like I think Austin has peaked now close to 64, 65%, but New York and some of the other large dense cities are hovering around that 40% mark. So with problems with physical occupancy, you have to expect that as leases expire, some firms may pull back a little bit. From what we've seen, though, it may not be as much as you would expect. We have seen some consolidation, but we've also seen some other firms take down more space, right? A lot of that is due to, well, for one, an expectation that we will go back in a little higher physical occupancy rate as things progress. And the other thing going on here is a lot of firms are bullish on their future prospects, right? So even if your, let's say, space utilization rate drops, or your square footage per employee drops, and you have some folks that are fully remote, others that are only hybrid, and they do some hoteling of desks. Even if that's the case, if you expect to grow, let's say you expect to grow 100%, you double in size, well, you may need actually more space. This is the US economy is an innovative, a knowledge-based economy. And if we're going to maintain that comparative advantage, then it might mean some of these firms expand. And we've seen that with big tech over the last couple of years.
Right. You got companies like Facebook and Google and Amazon that are out there gobbling up space, right?
Yeah. We have a new Google campus here in Manhattan, and they still, very much talk about the desire to be in a dense urban area to get the skill diversity of for employees that they need going forward into the future, right? And so, there is still this thought process that we're going to expand, we're going to need great employees, and some of the centers of economic activity that we have always had here in the US will continue to be, at least at some level.
And I'm glad you brought up the city, New York. Since you're there, I think the rest of the country could be curious about kind of what you're seeing there today as far as utilization. How's it looking on the sidewalks in the business districts?
Yeah, that's a great question. And I was there actually last week, spending a lot of time there, and probably less business attire on the streets, but maybe we've all changed and we're all wearing athleisure even when we go to the office. So that's not a perfect example there. But I actually was fairly pleased, I suppose, if you want to put me in that way, of the level of vibrancy in both Midtown and downtown. I spent time in both. Once again, the statistics we're getting are showing that physical occupancy is still down. And I think a lot of the people that I did see were tourists or locals. And some of those locals may be going to and fro from work, but others are just, doing their daily activity in Manhattan. So, for me, fairly optimistic, or what I saw gave me some cautious optimism for what I think we'll see. I guess the other thing to say, I did ride the commuter rail into the city, and that was fairly full. Even when I rode on an off-peak hour, there were quite a few people coming in. Once again, it seemed to be a mix of commuters, business commuters, and tourists.
What level of mask are you seeing on that commute?
Very 25%.
Okay, interesting. Yeah, I would think that would be a place that you would see more of it. and that's in tight quarters, right? But in
Yeah,
the office
yeah.
market, go ahead.
Go ahead, Michael. Sorry, no. Go ahead.
The office market in New York, though, is picked up recently, right? As far as activity and leasing.
Yeah, leasing activity did pick up quite a bit, and the first quarter was actually a really good quarter. We saw some positive pressure on rents. Net absorption was very good. Overall, there was a positive there. Very interesting, though, to see where the leasing activity has gone. A lot of people have been talking flight to quality. I was tracking that really closely through 2021, and really at that point was not seeing a lot of variation between Class A properties and Class BC properties. But then turn the year over, and the first quarter, net absorption in New York was, I think, a positive 1.2 million square feet for Class A, and about just less than a negative 1 million square feet for Class BC. So we are seeing a little bit of movement towards the Class A properties. And then when you dig in a little bit further, it's the Class A properties that you might consider trophy properties or amenity-filled properties or properties with views, great lighting, outdoor space. Newer properties are doing quite well. So this flight to quality with the economic rationale of that we have to entice some of our workers back to the office seems to be picking up some speed even in the data.
And here we are, mid 2022, Tom, and I guess it seems like in the past year or two, there's been some interest in suburban, office, right, and not so much CBD. What's the most recent trend there?
Balanced. I've noticed quite a bit of space being leased up in central business districts. It even surprised me. I was looking at Chicago statistics recently, and if you look at where most of the net absorption was in the last quarter, much of it was in and around the central business district, the Loop area. So, similarly with the New York area. Now, this isn't to say that suburban areas, in particular, newer properties, again, in suburban areas aren't doing well, but it is interesting to see that this is not quite a story of the downfall of the center city, at least not yet.
Yeah. So back to your forecast for a moment, Tom. So your overall forecast for office performance moving forward, recap that for me.
Bit of a bumpy road ahead. We don't expect there to be a huge spike in the vacancy rate. We do not think it's going to, peak past 20% for sure. If anything, we do see construction activity declining a little bit moving forward, and that should help with that vacancy rate. So right now, I said we're sitting around the low 18%. I think over the next few years, it drops closer to 16%. Still high from historic standards, but not too far off some of the long-term averages. And in terms of rent growth, weak. In the next year or two, don't expect very much more than 0.5% to 1% overall at the national level. And moving forward, as we kind of maybe reach a new equilibrium a few years out, getting maybe closer to 2 to 3%. But this is going to be an odyssey for the sector, right? As I started the conversation with, there's going to be a lot of trial and error, a lot of starts and stops as firms, try out some things. Maybe they work, maybe they don't. Some firms may move to different cities. This overall, again, an odyssey here. So bit of a bumpy road, bit of flatness on our baseline forecast.
Yeah. Well, that's better than the negative, I believe, right? So
for sure.
Yeah. And let's talk about the labor market a little bit and get your view on that, Tom, because it seems to me that for the office market to really rebound with any type of real strength, there needs to be some equilibrium in the labor market. If you try to do Elon Musk, right? Tell everybody to get back to the office, and you lose 10% of your employees immediately. Well, that could cause some problems, right? What do you expect for the labor market moving forward? When does it turn around, or does it ever?
Labor market's fascinating right now because if you look at job openings versus the amount of people looking for work, so the ratio of job openings to unemployed, it's basically 2-1 at this point. Now, a lot of those jobs are not in office using occupations. A lot of them still are in leisure and hospitality, but the labor market's pretty tight. So workers are quite emboldened when there is a mandate to return. Some of them may say, no, sorry, I'm going to look for a firm that allows me to go fully remote, or maybe only going to the office 1 or 2 days a week, or whatever their preference is. So I think we are in a period, especially while the labor market is tight, we're in a period where there's going to be some sorting happening as certain individuals, as certain laborers decide what's best for them and how they want to live their life, where they want to live their life, what type of commute they want, what type of office presence or lack thereof that they want. They're going to maybe move around a little bit and look for jobs that give them what they're looking for. Now, this does not mean that everybody's looking for remote work, right? I think we have to be careful about saying that everyone is against their commute. Everyone is happy with petting their dog all day. I mean, obviously everyone wants to pet their dog. I got mine right here. But, I think there are a lot of younger folks starting off their career that understand the value of being with a mentor on a daily basis to move their career ahead. I mean, that's the whole rationale to move to a city to begin with and to work in an office type of setting where you can network and you can really move that career forward. So, and that's shown in some surveys that I've seen that the younger generation is kind of craving a connection to wherever they're going to work. Now, does that mean they're actually going to do it when push comes to shove? And there's a difference between what they say on the surface and what they finally end up doing. I don't know, but I do think that there is this. I think we've gone too far saying that everybody wants remote, and that there aren't people that rather have more of an office setting and more of an urban type of lifestyle too.
Yeah, I certainly agree with that. I know in our shop, in our office, 90% of us really love being in the office, and part of that's having a good office environment, right? Well, Tom, what do you think about the labor market? When you look at the demographics of some of the baby boomers maybe starting to retire and that sort of thing, and kind of with this new sentiment that you've explained, what does it take to turn this labor market around to some equilibrium again? Does it take a recession or something like that?
Yeah, we, again, incredibly tight. I do not see us moving back towards that ratio of maybe 1-1, which is closer to where I think, well, we'll put it this way. I think there's a big story here, right? Right now, with all of the pressure, the tightness on the labor market, that puts a lot of pressure on firms to raise wages, and it keeps people spending. And that makes the Fed's job a lot tougher when they're trying to slow that rate of inflation. So you mentioned a recession. Unless we get unless our borders open up considerably to bring in a lot of skilled workers into this country, with demographics, as you mentioned, I don't see us getting very close to that 1-1 ratio without there being a little bit of recession, right? This tight labor market, there's no easy way out of this, not with the demographics that we currently have in this country.
And I find that very interesting because I think as long as there's a very tight labor market, it puts a little negative pressure on the office sector performance.
Yeah, I think you're right about that. I think whether it's the conversation that we were just having regarding the emboldened workers, or it's this unwillingness to expand just because you as a senior management hiring directors of companies don't want to get involved with the current labor market and be put in that position, right? You may not go through that expansion period. And so, yeah, I think you're right that this is not an ideal situation for the office sector.
Yeah. And Tom, let's talk about sale prices, cap rates, and things for the office sector. It seems like throughout the first quarter, in our shop at least, we sell office buildings, and we didn't see a lot of cap rate changes results in the first quarter. Kind of what are the more recent trends?
Yeah, what we're showing at our national level statistics are cap rates somewhere between 6.5% and 7% for the office sector. This is slightly above what we were seeing prior to the pandemic, where we were maybe around 6%. So there's a bit of a risk premium being built in given the uncertainty of the sector, the longer term uncertainty. But there's also, just pressure on cap rates given what's happening with financing costs from the increasing interest rates and just generally the cost pressures in the economy. So from a transaction perspective, we saw fairly slow 2021 with a little bit of pickup in the first quarter and these first couple of months now within the second quarter.
Yeah, it's interesting. We see the nicer properties we put out, the more occupied and stable. We get multiple competing bids, and we're still getting some pretty strong cap rates in the seller's view, right?
I think yes. There is a bit of a bifurcation here when it comes to office, similar to how we've talked about retail in the past, right? I mean, we're getting to that point where some of the older Class BC properties are having a harder time trade and at maybe a bit of a haircut, whereas some of those more amenity-filled trophy properties are able to sell at tighter cap rates and without any discounts at this point, because their occupancy is fairly good, and I think both the tenants and those landlords are bullish, and owners are bullish on the longer term future as it relates to office. Now, one thing that we haven't talked about that I think is interesting in relation to this is what's happening with the climate side of commercial real estate, and whether it's disclosures, whether it's commitments to reduce CO2 emissions. We are seeing premium on, say, LEED certified buildings and newer buildings that are putting in more advanced HVAC systems and windows that shade the sun to keep things cooler, right? So I think there is an interesting element of how ESG is going to ultimately play in the office sector in the relation between newer properties and older properties.
Yeah, and it seems like there might be some opportunities out there, right, for some of these B properties and maybe even C to create healthier environments and maybe get some good acquisition prices in this kind of window ahead of us, right?
Yeah, I think that's a really good point, that if they can find a way to make the renovations pencil, given the discounts that they might receive on the purchase of the property, and they're in a good area, then that could become a spot where there's that value add, right? And I think that's what a lot of folks with capital are looking for, right? But I think it comes down to what are the prices, what are the costs associated with those renovations to bring it up to speed, ultimately to get the deal to pencil properly.
Yeah, well, it's interesting. We just took out a $47 million LEED Gold building with a very strong credit tenant on a very sticky tenant as well in a very major Southeast market. And it's interesting to see kind of the response right now because of people's view of the office market. It really varies. It's pretty crazy out there. So what do you expect moving forward if you look in your crystal ball and you look at cap rates moving forward, Tom?
With interest rates going up still, a little bit more pressure for the universe, upward pressure for the universe, right? So I could see cap rates going into the sevens for certain properties, being approaching 8 or over 8 for some of those properties we were just talking about. But for some of those more trophy properties, cap rates could maintain in the 5s for sure. So, some variation there. Again, the bifurcation of the office sector, I think, is here for a little while. That might create some opportunities, as we were speaking about a moment ago. But yeah, with the current interest rate environment, and as we were just talking about with how strong the labor market is, I think the Federal Reserve will have no choice but to continue. I mean, they've already said they're going to, but I think this is going to be a continuation of increasing rates, increasing finance costs, and ultimately, that has to put some pressure on cap rates.
Yeah, it seemingly must, right? Well, Tom, what would you leave artists with to think about for office sector moving forward?
Cautious optimism, right? I think if I had to have a phrase there, I am an urban economist by trade, and one of the things we study deeply is agglomeration, or the value of proximity. That could be, firms close to other firms in a cluster in a particular city, or it could be within an office building itself. There's value of you and I interacting, right? And some of that value is just lower collaboration costs. Other parts of that value are the informal information exchange that actually happens within an office setting. And that, in a lot of studies, has been found to be quite valuable. And if you go fully remote forever, you lose that, right? You lose then also some of the mentoring, some of the coaching, some of the education that happens, especially for younger coworkers, ones that are starting off their career. Hey, I don't think, or very few people anyway, would disagree with me when I say that education at even the higher ed level is better in person. Well, that same thing kind of holds within the office setting. So I'm, a little more bullish on the fact that we are going to go back to the office at higher physical occupancy rates than certainly what we're seeing now. After this kind of trial and error period, we go through this over the next few years.
Yeah, makes sense. Tom, thank you for joining us, sir. Great information as usual. We appreciate you being on the show.
Thank you, Michael.
All right. And thank you for being with us around the country. We just also did a show this week on occupier strategies. So if you lead a business that uses space, check it out. We'll put a link in our show notes for this show. And thank you for joining us. Please let us know what you think. We appreciate you sharing the show. And until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Buxton. Take leasing, site selection, and due diligence to the next level. Make the right decisions with on-demand mobile data. Visit buxtonco.com. By Bull Realty. For proven commercial real estate asset and occupancy solutions, contact me. My email is michael@bullrealty.com. By Commercial Agent Success. Expert level commercial real estate broker training. Cloud Access 1 up to 21 one-hour videos. Visit commercialagentsuccess.com. Thank you for reviewing, subscribing, and sharing America's Commercial Real Estate Show.